Good afternoon, everyone. Thank you for joining today's session. Thank you for European Microfinance Platform for organizing this event and giving us the opportunity to speak all together at this panel today. I would like to start with a first introduction before I give the floor to my speakers. So a few words maybe about LuxFLAG. LuxFLAG is an independent and international non-profit association created in 2006 and based in Luxembourg. LuxFLAG is a labeling agency which aims at promoting sustainable and impact finance and also helping with raising capital to achieve sustainable investment objectives. LuxFLAG awards recognizable labels to financial products. And as of today, LuxFLAG has 4 impact labels: the climate finance label, the green bond label, the environment label, and the one of the most important, of the biggest importance for today's panel is the microfinance label. And then we also have 3 ESG labels, which are transition labels, and they are dedicated to investment funds, insurance products, and discretionary mandates. Today, LuxFLAG brings together the European impact investment industry for a panel discussion focused on impact labels, especially the LuxFLAG Microfinance Label, and the potential for promoting sustainable investments. After a short talk about the historical evolution of the microfinance, we will shift the discussion towards the regulatory implication for the impact asset managers. And so, dear speakers, the floor is yours. So first, maybe Tatiana, you would like to start. Tatiana Kalinina, who is with us today, is the Senior Sustainability and Impact Analyst at Triodos Investment Manager.
Thank you so much. Is my mic on? Perfect. Anna already introduced me. Basically, so I'll say just a couple of words about Triodos Investment Management. It's an impact manager based in the Netherlands, but working globally. So basically in all of the regions, Latin America, Southeast Asia, Central Asia, Africa. We have a number of different funds, and 2 of them out of 17 plus are actually dedicated to financing microfinance through financial loss of finance, financial institutions in emerging markets. And indeed, one of these funds, or maybe even both, are actually labeled microfinance LuxFLAG. And I'm very pleased to be here and to have this opportunity to speak to you. And I really appreciate you people who actually managed to stay for this discussion. Thank you so much.
Thank you, Tatiana. Next, Benoit Bouet, who's with us today, is Head of Debt, ICMA MENA at Responsibility. Benoit.
Thank you, Anna. So again, a few words on myself. So I'm Benoit. I'm in the impact industry for 15 years now. I've been working with different MIVs, mostly on the investment side. For the past 9 years, I'm with Responsibility, where, as mentioned by Anna, I'm head of the financial inclusion debt for the ECA-MENA region, which stands for Eastern Europe, Caucasus, Central Asia, Middle East, and North Africa. Just a few words on Responsibility. If some of you don't know Responsibility, so it's one of the largest asset managers in microfinance. The company is operating for 20 years. At first, we started with microfinance only, then we broadened the number of investment theses to SME finance, climate, agriculture, and we do debt and equity as well. Last year, we were acquired by a large debt house called MNG, and actually it's through MNG that Responsibility is coming today. MNG is based in the UK and really committed to also impact investment, and we wanted to be presented also today at this session. LuxFLAG, we've been with our funds are certified or with LuxFLAG for a bit of time, more than 10 years for sure. And it's important for us, and we'll discuss afterwards, because we talk to We have private investors, we have public investors, and obviously, depending on the crowd you talk to, it's important to have some labels. So super happy to be here today to discuss this.
Thank you, Benoit. And Aurélien Hollard is a lawyer and partner at CMS Luxembourg. Please, a few words about yourself.
Yeah, thank you very much. So indeed, I'm heading the investment funds practice at CMS Luxembourg, where we basically set up investment funds, but all type of investment vehicles. And I have been dedicating my practice into impact and microfinance since more than 10 years now. So of course, the legal and regulatory landscape evolved quite a lot since then. And that's why we keep having an impact team focusing on those products, because there are so many specificities linked to them, from blended finance solutions, and now the challenges we have with the ESG regulation. So it's a pleasure to be with you and talk about the labels.
It's a pleasure to have you all with us today. Thank you. And a few words about myself. So I am Annaletta. I have been working for LuxFLAG for 2 years now. I am a Sustainable Operations Officer, and I am in charge of reviewing the application for different labels, and I am specialized in the microfinance label. So thank you again for the audience, for everyone who's joining online and in person today. So without any further ado, let me start with the first question of today's discussion. So how would you define microfinance? How has your microfinance activity evolved in the past decade? And from what you experienced, what are the major changes you've seen in the microfinance market? And
shall I? Yeah, I'll kick it off. So microfinance is basically the part of financial sector that looks at financing the small businesses, individuals who are very often excluded. So it is about small, affordable, accessible, but also something that needs to be done in a responsible and sustainable manner. What I think we've seen in the past decade is that from microfinance, there was an evolution towards what we call now inclusive finance, because the scope was broadened to finance not just the micro enterprise, but also small and medium SMEs, and there is a lot of digitalization or digitization. I was confused which one is the correct one. So fintechs, but also pure digitization of traditional microfinance institutions. And that basically means that the scope is broader, but the idea behind it is still the same. It needs to be accessible, affordable. It needs to be about bringing in those who are, for whatever reason, excluded from the traditional usual financial services and products. And again, it needs to be done in a sustainable and responsible way. So yeah, sometimes you discuss the loan sharks versus the responsible microfinance institutions doing lending in a responsible way. So this is what we've seen. A broadening of the scope, and maybe some other things that we've noticed, at least in our portfolio. So move from a traditional group lending to individual lending increasingly. Also professionalization of those microfinance institutions that we work with. Many started as NGOs with really mission-driven, maybe even non-profits, but then going through different stages and evolving to full-fledged banks, still with pretty big portfolios in microfinance, and digitization that I already basically called out. So colleagues, please.
Yes, Benoit, Aurélien, would you like to add your views?
No, I think it's quite a complete view on the changes. I think to elaborate on what Tatiana said on the evolution of a microfinance, I'm always bringing this example. For instance, in one of the markets I'm covering in Kyrgyzstan in Central Asia, 10 years ago, there were only microfinance institutions that were financing the micro entrepreneurs through group loans. And in 10 years, it really changed completely. Group loans is still present, but it's no longer the main product. Also, all the microfinance institutions were transformed into microfinance bank, meaning that they can attract deposit, meaning that they don't rely only on investors. And it's a much more complex market. So it's important also to see that when we speak about labels, to recognize that local markets have evolved quite a bit compared to when LuxFLAG or responsibility were created some 20 years ago. These markets are much more complex, and the fact that they can attract resources locally is also changing a little bit the picture. They rely less on investors than they used to in the past. But also it's an opportunity to have a broader scope of products to end beneficiaries, because there's on top of loans, there's also saving products that can be proposed, or money transfers. So yeah, it has become more complex, and I think it's for the good of the end beneficiaries.
Maybe to add on it at the level of the funds, I think what we noticed for the microfinance fund that there used to be only DFI seeded funds, very complex structure, I would say quite heavy as well to operate, with high regulation. And a bit in the trends we see in the whole ecosystem is that it's getting to lighter regulation, simplification, in an attempt as well to attract private capital. So I think we tend to see that evolution, which in my view is positive. And at the same time, there are quite a few challenges around the corner, because there are currently a lot of MIVs, so which are open end, so where investors regularly can request redemptions of their investment, and that model of an open-end fund originating loans for microfinance institutions is likely to be a bit challenged at EU level. So the market, the players will have to evolve as well. So it's quite interesting to see how it will evolve in the next years. Yeah.
Yes.
Can I say something on what Orion said? It's indeed the model of open-ended funds is something that is challenging also for investors, for MIVs, because also then we are very, let's say, fragile when it comes to any major macroeconomic trend like it was in 2008, 2014. And yeah, whilst it was quite attractive in the past, I think more and more we will see more closed-end structures that will get the specific certification required to operate on a quite limited scale or limited product, to make sure that we also comply with investors' requests.
So those are all very interesting changes, and we've seen that there's been a big evolution. So microfinance market is an evolving market; it's not something that's steady. And maybe when we continue talking about this evolution, how has, in your view, the financial but also the non-financial performance of the microfinance funds evolved as well? And do you think that there is still a market for microfinance? Are we reaching nowadays more end beneficiaries than before, or maybe less? How the microfinance funds perform nowadays compared to the past? I know maybe Benoit would like to start on this point.
Yeah. So I think if we talk about financial performance, it has been overly stable in the past 10 years. I think MIVs benefited from the cycle in terms of interest rate. With low interest rate generally, there were a lot of investors that could consider something more risky, but with a social component as microfinance, as an interesting topic to invest into. When you get zero, basically, or below inflation on any product, the microfinance, which is very stable, but is being 3 to 4% every year, was quite interesting. And it was positive for the end beneficiaries as well, because it means that MFIs could borrow at a lesser rate, and then end beneficiaries normally would also get this decrease in the rate. Now we will see, since 2021, the post-COVID and inflation cycle now is going to be challenging. And today, typically, some investors that were just coming to see a bit the social impact and were interested by the actual return, they can find risk-free placements everywhere. So now we will see who is sticking, who is really social, who wants to be with us in the long run, are really committed, and the ones that were just a bit, finding some opportunities opportunistically.
And building on that, that brings us actually to the part of non-financial return and how the funds performed. And the trend here, or the necessity here, I think, is now to really be able to demonstrate that impact that you claim to have. So it's not only the amount of microfinance institutions or amount of borrowers that you reached, but also showing what impact did it have on them? Did the resilience increase? Did they build the savings, or so the life improved? How do you show that? So I would say that there is a certain level of professionalization in this respect also, even for impact investors with the DNA, where impact is in the DNA. You need to be now able to really show it, to demonstrate it, and otherwise, what really distinguishes you from the rest? Because indeed, microfinance is a mainstream, basically. So the way that you do it responsibly, and really the impact that you manage to get. And this is where we are right now working very hard on updating the theory of change, the impact frameworks, showing KPIs. Those things were tracked already, but I don't think they were very consistently explained. So what do these KPIs, number of borrowers, a number of female borrowers, what does it actually say about the performance of the funds? This is, I think, as much as I can say about that right now, the non-financial performance.
That's very interesting. And Tatiana, I have a question for you, actually. Do you think that, how digitalization open possibilities to invest in financially excluded communities? Does it allow for more financial inclusion?
Thank you for this question. It was triggered by a previous discussion that we had. So basically, the promise of digitization is that it makes things more efficient, cheaper, easier accessible, or at least more accessible there where it wasn't before. Maybe it is better quality, faster, and so on. So that's the promise. And I think in Triodos, we also have part of our portfolio increasingly dedicated to fintechs or highly digital, let's say, MFIs that provide digital products or use digital channels. So the question here is, and again, about measurement of the impact, is this promise really delivered upon? So do we see more inclusion? And this is a tricky one on one side, because it's a relatively recent development. On the other side, which KPIs do you need to use to really trace it? First time use, unique clients or whatever. So you can debate and discuss quite long about that. But one of the sessions here in this conference, which I found extremely interesting and was very, very helpful for me to internally answer this question, was on digitization of financial inclusion, where I actually asked this question to people who work in the fields, and the gentleman did assure me that they see that there is evidence that there is more inclusion. So previously not, so the target groups that were previously difficult to reach are actually now being included. So I think this is the proof. This is now the data that we need to collect to demonstrate this. So I'm very hopeful now, because before I was a little skeptical.
So thank you. We have a lot of hope, and that also this point confirms that there's a shift in the market. We go from purely microfinance activities, small level, to digitization and bigger scale activities and more outreach, actually. So now we are going to talk more about the labels and the regulation. So I would like to ask all of you if you have any sustainable finance or specifically microfinance labels, and what are the main benefits of the microfinance label for you, for your investors, but also for your clients, depending on your role. Benoit or Aurélien, if you want to start.
Okay. No, so we have quite a few labels actually. We track and we comply with at Responsibility. there's two sides to this question. One is labels give you typically a common language to talk to different investors. So when we market our products and we can show the labels, the ones who are smart enough to look at the labels before, they would know, and they would know, and they can basically benchmark our funds towards other funds which have the same label. So this is really positive in that sense, because there are different impact investors, some who have a deep impact, lesser impact, some that go deep into the market with technical assistance, so some which at another level. So labels give you this opportunity to have one common language. Also, again, to be fair, I'm more in the investment side, so I checked with my colleagues at Responsibility this particular question. And some also mentioned that it's a good way to organize a bit all the social reporting or all the data we collect. Because again, we know for sure we do impact, but sometimes we need to demonstrate it. And to answer to the label criteria helps you into structuring this. And also when we go to investors, that's we have this structured, and that's also something we can demonstrate more easily. So that's another positive impact for labels.
Yeah, it's true that before the regulation on SFDR, labels were one of the only way to give investors some certainty about the product, and in a way it was a way to promote as well the product in a clear manner. And of course, labels do remain very relevant, but today there is as well the compliance exercise. So the label must definitely differentiate itself from what would be pure compliance with sustainable finance regulation, and what it add on top of it. And we'll discuss, I think, a bit later that today, indeed, on the market, there are some uncertainties, and I think it's very important that labels keep that, let's say, additional element that can be given to investors as here is a product which goes beyond what is simply expected, which is a lot more specific, and that an investor then can heavily rely on it, even maybe with the post checks and so on the portfolio. So there is definitely something to work on labels.
Yeah, if I may, so we are an impact investor, but of course we raise money from partially. A big part comes from institutional investors and small part from retail. For institutional investors, it is indeed very often it's a requirement that they have a certain label. So, for example, microfinance LuxFLAG would be helpful in that, to show that indeed third party checked us and we comply with certain requirements, so they can be sure about this. But what I can also think about where labels can be helpful. For example, a new fund is established, and then a check that LuxFLAG is really helping them in sorting out their processes and establishing the framework, so that they also kind of learn and make sure that they bring themselves to that level that they need. So I can kind of see also that additional value of labels.
Absolutely. So we see only good points of the labels here, and as we like to say, the SFDR is the basis for the label. Okay, we take it for granted, and then we will add also a lot of criteria on that, which the asset manager needs to check and make sure they are compliant with. So those are very valid points you mentioned here. And this actually brings us to our second point on the regulation. So we know that there is the sustainable finance regulation you already mentioned. And I would like to ask you how this so-called SFDR is affecting the microfinance funds and their managers.
Maybe from I would say, and when we look at the labels as well, I think SFDR came up as a transparency regulation. So it's a transparency regulation, but the market took them as almost label-like regulation. Because I think investors, they need, when we advise on investors negotiation, they always look for protection. They look for certainty. They want to be, and they look for benchmarks. Usually they just say, the thing is, let's not reinvent the wheel. And it always starts like that. But then every time we reinvent a bit the wheel, but still they look for clear benchmarks. So today with the SFDR, the regulation, there is, of course, so Article 6, Article 8, Article 9, which are a bit taken by the market as quasi-labels, although they are not. Mm-hmm. And that's where there is, I think now, a bit of misunderstanding, because when you come with your label, investors would say, okay, but microfinance label, how does it relate to Article 6, 8, and 9? And it's true that you need to be very consistent and I would say as well, provide an additional value as to what it is with the regulation, which I think is exactly the approach you have. But it can create some difficulties because, and I think we'll talk about that a bit later, but if you say you are a microfinance fund and you are doing it for 10 years, but according to, let's say, your compliance department, you should be an Article 8, so promoting sustainability, but not doing only sustainable investments, you're still a microfinance fund, but you're an Article 8. And people say, oh, but you're an Article 8 while you are an impact fund. So I would expect you to be an Article 9. And here start discussions, which I think would really need to be clarified in the current.
Maybe we will just discuss it later. That's a point to come. That's a very interesting point, but let's keep it for later. And in the meantime, maybe Benoit and Tatina, you would like to answer the same question about regulation.
No, so it's so regulation being regulation, it's quite strict, and it's interesting, again, a bit like for labels, it really changed the way we work. We are working in a certain way, just being convinced then ourselves we're doing the sustainability, and then you have to demonstrate it, and it's taking a bit of time. It's actually very concretely, we have people just for this to be able to report completely to all the SFDR regulations, which was not the case in the past. Obviously, we had all of this. We had for labels like LuxFLAG, we have to send some data every year, but this is quite easy with the data we gather in general. But for SFDR, of course, it's much more challenging. Again, I think it's positive in one sense. It's a common language. You need to be in that. There's no way out of this new regulation. But also for smaller companies, I mean, responsibility is quite large. It has more than 200 employees, but still, you need to allocate specific resources. And I wonder, smaller funds who maybe have even a more impact DNA. For them, I think it's very difficult to comply with all the data that you need to send and to provide and to update regularly. It's a challenge. The fact also that we are part of a larger group with MNG. Also, they showed us how strict they are on that topic. So it's I mean, you cannot really play with this regulation, and it's a challenge even for a larger fund as a responsibility.
This is a very fair point, but not to repeat my colleagues, I'll try to bring something additional into this. So it is a lot of work, let's say, for the investor. And once again, even with impact as DNA, what we had to do is rearrange the processes and templates and how we collect information, how we report information, especially what information, how much of it, do an analysis of, okay, so what information that we already have available can we report in the way that SFDR requires us to do. So that was a lot of internal work that, you don't see from outside. And it is really rearranging things, not introducing new stuff, not doing something different, but really rearranging how we report that. But in addition to that, and I think in this, you really see the positive and actually that intention that SFDR had is to make things more transparent, more comparable, more fair, if you like. So we had to make a lot of things more explicit. We don't we see that we imply something in saying that we are doing impact and that we are not doing harm and so on, but showing again that data and that evidence that it is indeed that what we say, now we're forced to do that. And I actually see it as a positive thing, because now there is really a drive, you know, to be very serious about this. On the other hand, and this is now a discussion in the impact investor community, is really all of this data equally relevant, or the depth in which we need to go, is it equally relevant, especially when we speak about microfinance in emerging markets, so the realities of it. But that will probably be the next question.
The data topic is on itself a very broad topic, but it is indeed something that the SFDR also brought on the table of asset managers. I see that indeed what you mentioned is that SFDR was not really awaited, but it was needed somehow. And we see the benefits of it now, and we probably will see them more in the future. So I will like now to ask a bold question, let's say. So Aurélien, this is first for you, my question. Can an Article 8 fund, SFDR categorized, be considered as an impact fund?
Yeah, and then we enter into the definition category, and we all know, you know, about what's impact. For me, related to that topic, SFDR was not awaited or necessarily needed as such by the impact community, but it was needed for the investment fund industry as a whole. So it filled the gap. However, it filled the gap where players, microfinance funds, impact funds, already developed their own framework towards sustainability, because you know, they are committed to a double bottom line. So it's not only about the return, but there is non-financial return. And the question of the non-financial return was never discussed, regulated before in a mandatory manner. So that's where I would say it played a bit against the impact community, because they had already their framework, which were designed by years of experience, of expertise, and they had to reframe it to adapt it to that new regulation. So for those who had little things or nothing, it was great, because it made them improve towards integrating sustainability risks. But for those who had a lot, it made that issue of, oh, I'm an impact manager, I do impact funds, shall I do Article 8 funds, shall I do Article 9 funds? Of course, I would tend to say all impact funds should be Article 9 funds by design, because an Article 9 fund is a fund which is investing in sustainable investments. So that's really the purpose. However, here you can play with definitions. What is a sustainable investment? Of course, it has to contribute to social or environmental objective, but without substantially harming any other dimension, environmentally or socially. And then you could think, oh, but what about my microfinance fund in that context? Have we already anticipated that? And do we have the data about whether my activity can generate harm on the social or even environmental aspect, which is not the design of my fund, because it's a social fund. So I believe here there is clearly not there is a mismatch between the regulation and what impact players had already put in place. It's at the same time an opportunity, because it draws the light on a new dimension, do not significantly harm, and market players had as well to adapt and take that into consideration. But at the same time, it came as an incredibly high cost for players who were already involved in the sector. Yeah.
May I jump in?
Yeah.
What you're saying? Just so you started talking a little bit about the obstacles. So could you please elaborate more on what are the obstacles that prevent the impact asset managers from achieving the SFDR Article 9 classifications? Yeah. And is this Article 9 actually a guarantee of impact then?
Yeah, so I would say first, all impact funds should at least be Article 8, because there is clearly a promotion of social or environmental characteristics. There is no discussion about it. Then whether it can be an Article 9, the question is, you know, we look at, for instance, the labels. If you're a microfinance funds, you need to invest at least 50% of your portfolio in microfinance. It's not 100%. When you look at the Article 9, you need to have your full portfolio invested in sustainable investment, and it has to be sustainable from the day you invest in. So even all the assets, all the activity which is transitioning from something where you invest, which is not already like in private equity, you want to transform the company to a sustainable company, your investment in it will not be a sustainable investment because you're not investing from day one in a sustainable investment. So you can imagine how, with a game of definitions, you can have a very valid impact portfolio, but because it is not 90%, 100% compliant with a sustainable investment definition, then you feel that you should not go for Article 9, remain Article 8. And that's where the misunderstanding sometimes with your investors starts, because they will say, hey, it's an impact fund. Why are you not a 9? And then you need to discuss.
Yes, for sure. And Tatiana, maybe you have your views on this.
Yes. So not being a legal person, I'll be very honest with you. At some point in this discussion, so all of our triodos funds are classified as Article 9, and there was a lot of legal people involved, exactly cleaning out, like, are we compliant with definitions, which sometimes is a little bit, I mean, goes beyond the spirit of the law, if you like, because we're really doing that what the law requires us to do, but we need to make sure that also by the letter of the law, we're doing exactly that and not like half a millimeter to the side. So that was quite an exercise. But I think, and the discussion that we also had, like, does it make so the fund that went through all of this trouble and is classified as Article 9, is it then by default an impact fund? So I believe that yes, because when we look at cost, both in efforts and money, really cost of this, and the benefit that you get from that, being Article 8, Article 9 is not, I mean, Article 9 is not more beneficial. So if you went through all this trouble and you became Article 9, then you must be an impact investor. That, but I'm a little bit, maybe I'm putting it a little bit plain here, okay? Not a lawyer, so.
It's a valid point. And Benoit, do you agree with Tatiana?
Yeah, it's quite valid view also what Aurélien mentioned. I don't have something more specific to add to it, but just to emphasize, it's a complex journey to go through this Article 9 whilst we are thinking we are doing this for many years, and it is a challenge.
Okay, so thank you all. This was a very interesting point about the regulation. And now I have another question. It is still about regulation, but not only European regulation. So what are the main discrepancies you observe between the European microfinance regulation and the regulation of countries where the microfinance institutions operate? And how would you address them? Is there actually a way of addressing those discrepancies?
I'll probably jump in then. So how I understand this question and how I would offer an answer to that is not so much about discrepancies, but rather, so the requirements, and now SFDR is a very prominent one, that and expectations that are included, let's say, in those requirements of SFDR are very much European-centered or global north-centered. They assume availability of certain information, data, assume, I guess, certain infrastructure, which is not available in global south, let's put it this way. So this is, I think, the biggest, if you like, discrepancy or mismatch. At the same time, so basically this situation where we are right now, being a European fund, we are obliged to report according to SFDR, which requires us to collect certain information in a certain way and so on. And we need to collect it from our investees, financial institutions in global south, which cannot provide this data. It's very difficult for them to prove certain things, like, for example, the minimum social safeguards would be speaking about policies, but also mechanisms of protecting human rights, labor rights, and so on. How do you check all of this for private equity, so not listed companies, where there is very little data available, and collection of this can be prohibitive in costs that you would actually have to incur to really dig to the all the way to the bottom. So this is where we see the biggest challenge, I think. But besides that, if you like, and that was also mentioned by the gentleman in one of the sessions, when some countries or even continents are only responsible for like 2% CO2 emissions, and you really put all of this effort without the infrastructure and so on collecting GHG data, so you end up basically doing a proxy. So it is really not, the data of very low quality. Is it worth it? Which risk are we mitigating? So these kind of questions arise, and and that makes it quite challenging, this whole exercise.
Benoit, you had
I had one example of the same topic is we have one equity investment and debt investment in a company in a country who energy production is mainly from coal, right? And this bank is actually trying as much as possible to avoid any connection. But, it's like 60% of the energy of the country is coming from coal. So they have a little 1-2%, and we had to ask hundreds of questions and the plan how they want to exit that particular partner. And of course, it's creating a bit of a discrepancy, as you were saying, or misunderstanding. Is that they really don't get why. 95% of the portfolio is okay, and then we work with them for 10 years. And we should be a bit more flexible on that. But no, we have to really, it's fine. If there is a plan, we can explain. But still, I know for sure this plan does not make much sense in terms of a market rationale. It's actually better they invest, also helping this particular company to improve their energy efficiency, rather than saying, okay, this is out of our portfolio. So yeah, there are some very details here that is taking a bit of time, and that also show that the regulation per se is missing some very specific topics. Yeah.
I see. So it's very interesting to see that in Europe you have SFDR, which will then rely on other regulations to collect data, but there are no such regulation in other countries. So it poses a burden for asset managers. And this brings us to the next question. So as you explained, the SFDR doesn't really fit the microfinance and impact industry. So in this context, what is the relevance of the microfinance label, and how can, in general, labels fill the gap between the sustainable finance regulation and the needs for disclosure in the impact industry?
Maybe can start from a more legal regulatory approach. Clearly, a regulation is not by design a label, even if today we talk Article 9, 8, there is, if you are doing a non-regulated fund, there is nobody behind you checking anything. It's, you must be compliant, but if your fund is not regulated, there is no the CSSF in Luxembourg or in other countries. You do basically, you self-apply what you feel is what you need to do. You collect the way you feel, and nobody's checking anything. Maybe at some point, if something happens, investors can start complaining. It's another story, but there is no checks at all. For a regulated fund, it's a bit of a mix, because the regulator is here. Of course, we'll check that the documentation, but the regulator is not going to check that the portfolio is indeed invested as it is. There will be data collected and so on, some reporting, but it is not the same level. So labels, if they provide that to the investors, there is nothing compared. It's really an additional value. So in terms of quality of the documentation, it can go necessarily the extra mile, but then it's as well for the monitoring, supervision, checks behind it, which is then no longer a question of compliance and transparency, but it's really that you effectively implement what you claim you do. So kind of checking the claims based on the label. Yeah.
Yeah, we are a guarantee of standards, basically. That's That's very interesting. And do you guys have something to add on this point?
Maybe I think once the industry would have swallowed this new regulation, the need for labels will come again. I would say now everyone is focusing on, okay, let's get compliant with the new articles, and it's taking some time. We've just explained. And after, I'm pretty sure people would say, okay, but now I need more to see from, you know, Article 8 or 9. Okay, but I want to go further. I want to get more impact. So where do I go? And probably that's where impact could also come into impact labels could come into the game. Yeah, this is what we expect. That responsibility for sure.
True, and this time the labels could use, for example, to look at sustainability objectives and impact part, because SFDR really regulates the part of do no significant harm, so looking at that side, but sustainable objective, I think it's left very open, you know, so maybe there labels could play a role, helping different investors differentiate themselves. Okay, my sustainability objective for this, your sustainability objective for that, and that will help us. So labels could look into that. And one more thing that I wanted to mention, looking at labels, because I work mostly on the side of investments into microfinancial institutions. So looking at them, how well they have their, let's say, processes and so on. For example, client protection, pathways, certification, and so on. So I was always wondering, how do labels look at that? And would it not be a good idea maybe to also create this link where we as investors checking it according to certain standards and certifications also can maybe translate into a label that looks at that and shows it to our investors that we follow this standard. So just a suggestion also on the sustainability part.
But we take it into account, and I guess so far what the label tries to promote is mainly the best market practice. So no matter what kind of standards you decide to use, we would like to see them being indeed implemented. What we really want to see is that someone coming for a label is indeed applying what it says and doing the best they can. So I think this point would conclude our discussion today, but we are open for questions. So we would like to take any questions that are from you guys in the audience, and maybe if there are some questions online as well. So if there are any questions.
I think it was crystal clear, which is awesome.
I have a question. So there's no microphone.
No, is there no?
Just one question, a bit more a legal question. Just according to the European Commission current public consultation, that is supposed to have a kind of labeling scheme. What's your view precisely what's going to happen? Because everyone makes a lot of effort to translate into the Article 8, Article 9 as per SFDR, and now maybe the idea is again to start on something a bit different. So thank you. Not only you, Aurélien, maybe.
Yeah, no. Yeah. I think everybody recognizes that SFDR is not perfect. But at the same time, I have the feeling as well that nobody wants to start something from scratch again. So it's very likely that what we know today as 6, 8, and 9 will remain, maybe under other terminology, but I think it would make sense that what has become already and has been extensively debated on the market remains. But that indeed, instead of only transparency requirement, they transform into true labels at the same time. And that's so I think it would be even a recognition of the markets. It would be a recognition by the regulator of what is already considered by the market as basically labels, de facto labels. However, the question is how all that will be organized at EU level, because it's a huge work then if you want to centralize that. So I could imagine that they will rely on authorized labeling agencies to be able to provide those labels, and that the labels of the agencies will be complementary to the one which are mandatory or which are offered by regulation. So it's honestly it's hard to know now which directions, but I cannot imagine that we will get rid of what we know today as the SFDR, and that it will be to build on the existing framework and go one step further. And in my view as well, working with existing agencies on future labels. Yeah.
Not really answering your question, but just slightly to elaborate on this is, and as I was mentioning, I think would be interesting to have also from LuxFLAG new potential labels, or that would actually update a little bit the ones that are existing. I was mentioning to you before that when we do closed-end funds, now we mix two different topics, so we can have microfinance with health, microfinance with climate. You mentioned this 50% of microfinance, and what we see in our portfolio, of course, we see more and more SMEs, because also the outreach they bring, and the fact that these are created jobs, and the scale is different. So to have this kind of new labels outside of a regulation, that to be updated, to be able to have again, to be certified in those labels, and to be able to demonstrate this to investors. So I think that's something we would be very happy to see and to participate in.
I'll maybe give it a slightly different twist. So as you know, right now there is this consultation ongoing, right, for revision of SFDR, and this is the opportunity to really give that feedback of things that are not really fitted. And of course, it wasn't created specifically for microfinance, so we're using this opportunity right now as a big group of investors to bring back things that are working, things that are not working, that we would like to see them differently. I would just invite everyone who has any interest in this, maybe go through this 200 pages and provide your feedback and help, because so European Commission took really an immense effort, I think, to put it together. There is a lot of useful and really necessary things in there. It's not perfect, and we now have an opportunity to to make it a little bit more workable for everyone. So I would invite everyone to do that. So, positive message.
Positive. Thank you for this positive end note, and maybe to answer to Benoit's concerns. So we at LuxFLAG, we are currently updating the criteria of the microfinance label, so following the market evolution, and we might be working on a different project that would include different funds which are doing different kind of impact than only microfinance. So there are some future updates to follow for sure.
Thank you.
So thank you. So if there are no more questions, are there any other questions?
1, 2, 3. No.
No. So that concludes the panel, and so thank you, Tatiana, Benoit, and Aurélien, for joining us today. It was a very interesting panel. Hope everyone has enjoyed, and thank you all.
Thank you, the audience. Yeah.
Thank you.